Hey, good morning, options traders. Happy Friday to everyone. And I thought this would be a perfect time to revisit an old theme. Talked about them before, what I call idiotic ideas. We're up to number 12. And as a quick reminder, these are from a book, which I'm not going to release the name or the author because that's not really the point. The point is to show why you have to get your education from reliable sources because there's a lot of really bad information on options. A lot of these strategies sound like they make sense, and a lot of people put themselves out there as professionals, such as this person, saying, here's some really good ideas. And all I can tell you is that this book is chock full of ideas. Not good ones for options traders, but great ones for videos. So let's take a look at number 12. Use naked puts to buy stock at cheaper prices. What's this all about? Let's go find out. As always, before we do, please be sure to click like and subscribe. It's truly appreciated and helps to promote the channel. So out of this book, here is a direct quote. And he says, because the average investor has a tendency to buy stock at higher prices than desirable, naked puts have a particular advantage. When you write naked puts, you are forced to buy stock at lower prices. So the key there I want you to focus in on is lower prices. Is that really true? Again, it sounds like it's true if you understand the basics of the strategies, but you're going to find out it's just the opposite. So, quick review of naked puts. This just means the word naked in the world of options just means that it's unhedged. So, if you sell an unhedged put, it's a naked put. So, what does it mean to be unhedged? Well, you don't have, let's say, short shares of stock or another put in the account that could counterbalance it. It's just a short put. So, for example, let's say that you sell the $100 put for $2. So you collect $2 or $200 because each contract controls 100 shares. Now your max gain would be the $2. That's true whenever you sell an option, call or put. The amount you received is the best you could ever do. But in exchange for that, you have the obligation to buy shares for the strike. So in this example would be the $100 strike. Now with a naked put, you have unlimited downside risk. And if you're buying shares at 100, or at least have the obligation to buy there, it's a long ways to go down to zero. Now, of course, it's highly unlikely that a stock will hit zero, at least in a super short run, but you could definitely take a very big hit. Certainly far bigger than the $2 you collected for entering the position. So if you did this, if you sold this $100 put for $2, this would be your risk graph. So recall that we always get a bend at the strike. Whether it's a call or a put, you will always create a bend at the strike. Since we have the $100 strike, we know that we get a bend there. This is the risk graph for a naked put. Now, let's say that the stock is up here when you sell this put. It's trading up at, let's say, $110. And so you're thinking, well, if I sell this out of the money put, if I sell this $100 put for $2, it's a low chance that it's ever going to get there. And if I do get assigned, it's a good thing. The stock's up here at 110 and I can buy stock for 100. Well, is that really true? Will this allow you to buy at cheaper prices? See, it sounds like it because the stock is currently up here at 110 and you're thinking if I sell the 100 put, I might have the opportunity to pay 100 and therefore I would be buying stock at cheaper prices. But you have to understand from a trading perspective, when we are talking about price, the current price is what matters, what we call marking to market. The price you paid has no bearing on the decision. We've talked about that before in previous videos. That is a sunk cost. And that's not going to be affected whether you continue to hold the position or close it. So see, the problem with this perspective of saying, hey, look, you can sell this out of the money put and buy stock for cheaper prices is that you can always reference higher or lower prices. See, so it doesn't really accomplish anything. So for example, let's take a look at Nvidia. If you bought shares of stock, let's say down here, did you buy at a low price? Well, it depends on where your reference point is. Sure, any of these candles along here, you might say, oh, I got a great deal. I got them at a lower price. But that's because you're referencing a candlestick at a higher price. See, I could just as easily come back here and say, no, you bought them at a higher price. It's much higher than here. I could also come back here and say, no, it's much higher than here. So is this a higher price or a lower price? It just simply depends on what you want to compare it to. But we can always choose something higher or lower. So that's definitely a big problem when you're selling naked puts and saying that you have the ability or the possibility to buy shares at a lower price. That's what makes people want to sell those puts. I'm getting paid cash up front, and if I end up buying the stock, I'm going to buy them at a cheaper price. But if you come back to the chart that we saw before, you'll see that's not true. Because if the stock is up here at 110, if you could sell a naked put and buy stock for 100 today, that would be a really cool trick. Yes, in that case, you can't argue it. The naked put allows you to buy stock at a discount. But that is not what's happening. So remember that if the stock is anywhere above this strike, you are not going to be the buyer. The only time you're going to get assigned on this $100 put is if it's advantageous to the put buyer. That's the person who has the right. And that put buyer is only going to exercise if it's advantageous to him. And when is that going to happen? If the stock is down here somewhere. So the only time you can expect to get assigned and therefore buy shares for $100, because remember, you have to pay that strike price. If you sell the $100 put, you are going to pay $100 per share no matter where that stock price ends up. And what does that mean? If the stock is down here and you're paying this price, you are buying at higher prices. So to say that the advantage of selling the naked put is because you can buy stock at lower prices is just flat out wrong. Yes, naked puts, like any strategy, can have good uses for the right reasons at the right times. But if you're ever told the reason for using the naked put is to buy shares at a lower price, it's just an idiotic idea. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a candlesticks and technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.